Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. And if you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone, welcome back to another weekly Roundup edition of On the Margin. Today, I'm joined, as always, by my indubitable co-host, Mr. Mark Fusco. Decided I'm giving you British-sounding adjectives.
Indubitable, because it's going to be jolly good in jolly old England in March of 2024, right before the big halving, and we're going to talk a lot about the halving today. In fact, do a little reveal. I got the green candle pants on today because it's been so awesome. And I have the halving socks. Now, what's amazing is I just realized that I've been wearing Mount Sock's sock game for the better part of 4 years, every day, pretty much, and starting to wear out a little bit. And I kind of need the 2024 halving socks if they're listening and if they've made them yet. If they were to show up, that'd be good. But it's pretty crazy. I mean, it's interesting. This week is the 10th anniversary of my meeting with Dan Moorhead out in San Francisco, where he sat me down and said, "Hey, I'm shutting down my hedge fund." And why would you shut down a hedge fund and give back $1 billion charging 2 and 20? And he's like, "I'm going to spend the rest of my career in Bitcoin and blockchain." And I'm like, and look, I say this all the time. I was not running drugs on Silk Road. I was not a cryptography student. In 2013, I was like, Bitcoin? I mean, I'd kind of heard about it, not a techie nerd. I'd heard about it, but I didn't really know about it. And, but when he said blockchain is the, infrastructure layer for the new web, I'm like, okay, infrastructure, I understand. I made a lot of money in infrastructure over the years. I mean, not me personally, but for all the people that I've worked for. Everybody knows my story about Google and, $200 million for Notre Dame from $500K. But infrastructure I got. And so invested with him in his first venture fund. And, it's like a 11X or something. It's been great. But I should have bought the Bitcoin fund because it's up 300 plus X. But I didn't. And because I was skeptical and I didn't really understand and I hadn't done any work. And then, everybody's heard the stories too that, I did the work in 2014 in March. And I thought, okay, it's pretty cool. And I wrote about it. And my clients were like, "You're an idiot. Don't talk about this. We'll fire you." I'm like, wow. I mean, that's just a violent reaction. And I guess that's the reaction that people have to new ideas that they don't really understand. That's the reaction people had to the internet. That's reaction people had to computers way back when. The horseless.
It's always incumbents too, right? It's like when you have a new industry, you're disrupting someone else. And so, all right, I'm going to shill a Twitter account here that I absolutely love. It's called Pessimists Archive.
Oh my God, that's it. That's where I saw it. Yep.
Yeah, Pessimists Archive. Great account where they basically, I don't know how they get these old clippings from newspapers like the Times or whatever, but what they do is that they go back in time, go back to 1800s almost time frame, and they'll clip things that people were pessimistic of and suspicious of. And it's things as mundane as bicycles, Mark.
No, absolutely.
There are anti-bicycles, yeah.
Bicycles were like you were the devil's spawn if you rode a bicycle.
Yeah.
Like a proper person would never ride a bicycle.
I promise you a London historical fact every week. I've actually got a good one for you, and then we can get into discussions of, I want to talk to you about crypto and I want to talk to you about macro this week. So this one is going to, honestly, the visual of this just made me laugh. But so back in the Tower Bridge in London, which is kind of that famous, it's got the blue archways, et cetera. So
London Bridge is falling down, but that's called the Tower Bridge. Yep.
Yeah, exactly. So back in 1952, it started to rise when there was a bus driver that was still on the bridge. This guy's name was Albert Gunter. And he ended up being in this situation where he was on the bridge. It was rising like this, and he had to make a choice about staying put and falling or gunning it. This guy gunned it, cleared a 10-foot gap. And you know what he got in reward for his quick thinking?
Fired.
1 day off.
One day off.
1 day off. Isn't
Better
that just
than
the funniest
fired.
thing you've ever heard? Yeah, it is. It is better than being fired. Yeah, my God. But anyway, a little bit of a London history fact to get you all on the edge of your seat this morning, and the visual of that.
Because the history of London is extraordinary, and much of the history is just so cool.
Just to wrap up and put a bookend on what Mark and I are talking about, we are talking, of course, about DAS London. This is the conference that both Mark and I are going to be at March 18th through the 20th in London. We hope that you'll all be there. Again, use code MARGIN20. We've had a new slew of speakers go live today, some of whom have been on the show. So we'll have Michael Howell, Joseph Wang, Julian Brigden. So there's going to be a very cool blending of the macro and the digital assets in Bitcoin. We're going to have Santiago Santos, Tara McCauley of Lantern Ventures, Eric Balkunas, who's the ETF guy over at Bloomberg. So really good crowd. We hope that you join us in London. And again, use code MARGIN20. Okay, let's move on here to, I want to get your opinion on what's going on with Bitcoin here, because I think as we're recording
the
this,
warm up act. This is like it's like Toto, warming up for Journey.
Okay, so as we're recording here, Bitcoin actually just crossed, even as we've been recording, 37,000. And if this is well, I have an opinion on it because this is sort of triggering a memory for me, but the price action here does look a little bit bizarre. So just to refresh for listeners who might not have caught our last couple episodes or might not be as in tune with the price action of Bitcoin, Bitcoin basically had this false start, this ETF false start, courtesy of the Cointelegraph intern. We're sort of joking here, but really a couple of weeks ago, the Cointelegraph Twitter account tweeted out that the iShares ETF had been approved. It was just incorrect. But what it did do was it caused this big run up in the price of Bitcoin, which it retraced a little bit, but it's been on this slow grind up ever since. And if you're following along via video here, what you can see is this sort of, I guess, just funny price action where it runs up from 27,000, straight up to 35, gives a little bit back, but it's been kind of slowly edging up here. And now we're at the point where just over a week prior, we're now over 37,000. What do you make of this, Mark?
The bottom line is people are getting the joke, right? And the joke being that despite all his best efforts to, delay and obfuscate and stop the train, right? The train's coming, and the ETF is going to be approved. We've seen all this stuff about the QSIP being released, and so it's coming, and I think that's certainly part of it. But most importantly, this accumulation pattern has been going on for a year, right? This is 2 days ago was the anniversary, the 1 year anniversary of the fateful day where FTX ceased redemptions and withdrawals, and then everything came out that there were just bad people doing bad stuff, and we had the crash, right? We had the crash from the low 20s all the way down to 15.9. And it was like, oh, you said the bear market was over in June, and here we made new lows. I'm like, look, yeah, I did. And because I did not see Hurricane Sam coming. I didn't. I did not know he was a fraud. I talk all the time. We skipped, we didn't invest, but we didn't invest because we thought he was a bad guy. We did invest because the valuation was dumb. But I didn't see it. But from that point, and you can go back and you can, the nice thing is you can roll back the tape. You can watch the shows from right around a year ago where we said, this is it. This is the cathartic kind of, bottom. And now we're going to slowly grind back toward fair value because all the bad news is kind of out there. And, the difference between crypto spring, crypto summer, and crypto fall is crypto spring isn't the big bounce off the bottom. That's not what crypto does, right? The bear market, crypto winter is bad, right? Because you're not only unwinding the degenerate gambler leverage, but you're in a very illiquid market that has all these gaps and it's just bad. And the haters are out and the boo birds are out. And so it's bad. And so you're not going to get like the classic, S&P bounce. When the S&P has a bear market, it does the V-shaped bottom. That doesn't happen in crypto. You get this kind of bounce along the bottom and kind of slow grind. I think about spring. It's windy, it's muddy, it's kind of not really that nice. And you can kind of go out and kind of do stuff. But then summer comes and everyone's like, well, summer means, we're going to be straight up. No. Summer is that slow accumulation. People are coming back. They're getting used to being excited again. And it is this series of higher highs and higher lows. And if you look over the last year, we've had exactly that. Higher highs. Doesn't mean we don't go down. Doesn't go straight up. Doesn't mean up every day. But the real difference is bull markets and bear markets are fundamentally different. A bull market is a market that goes up most days, but goes down sharply on bad news or perceived bad news. Okay. That's a bull market. Okay. You don't have big down days in a bear market. You have big down days in a bull market, right? Because you don't believe it. And conversely, a bear market is a market that goes down most days, but goes up sharply on good news or perceived good news. And so all the big up days in markets happen in bear markets because people are like, it's over. And boom, short squeeze. And then it's like, it's not over. We're still going down. It's like a ball bouncing down a set of stairs. Each bounce is higher. It's just kinetic energy. But the end of the trip is a bad place. And so we are clearly in a bull market. And I love the fact that Morgan Stanley, like last week, came out and said, we think crypto winter's over. Oh, you think? Like it was over almost 2 years ago, 18 months ago. So get with the program. So we are still in crypto summer until next June, post-halving. Then we get to crypto fall. And crypto fall is the fun time, right? That is when the MOMO and the FOMO and all the, but then, you go from, FOMO to MOMO to oh no, because then you start crypto winter again on the other side. So anyway.
Yeah. You know what? That's a really good framework for listeners. I don't know. I was trying to think back and put together almost a checklist. So I put together this list. I hate to share screen on one of my own tweets here, but I'm like, history. I think that the lesson of this last cycle is that history is not going to repeat exactly, but it is going to rhyme.
Yeah.
And I put together this list of like things that I sort of remember happening at the beginning of the last cycle. And it was, idiosyncratic PvP rallies within crypto. So like the success of a couple small things, which like gets the people going. This is for the crypto natives only. It shows the like willingness to return to speculate and gamble again. It shows that there's some energy. I feel like you've seen that in a couple of different respects. Friendtech, Solana, Chainlink. You're starting to see these like small idiosyncratic sort of rallies break apart. And this was DeFi summer back in 2020, which ran really like ahead of Bitcoin.
By the way, I'm taking full credit for the Solana pump. I'm taking full credit, right? They came at me. The Solana fam came at me because I said, transactions vaporized. And I met with a couple guys and I said, you know what? Fine. I'll believe you that you fixed it. And so, I'll be positive. And since then, it's more than double. And I mean, I had nothing to do with it, obviously, but I am taking full credit.
Congratulations to that whole community. It feels like there's a rebirth going on over there. We're rooting for them. Then Bitcoin runs. Bitcoin is starting to run right now. And that I remember this dynamic last time too of option sellers getting caught off sides. So the the option seller dynamic is one of picking up pennies in front of a steamroller, right? You're sort of constantly selling options. You're clipping this premium and it's a short volatility position. Actually, the last time who made a lot of money doing this is the now infamous Three Arrows Capital. Made a bunch of money buying up those options that were mispriced because there was a bunch of volatility incoming. Turns out that was a very good trade. And I do sort of wonder if what we're seeing right now is a little bit of a gamma squeeze action here, where there are some option
100%.
sellers which are caught offside, and I feel like that's starting to happen again. But the thing that we really need here is for Bitcoin to run a little bit harder, and then you'll start to see other things like Coinbase hasn't gone down yet. A text from relatives. My dad listens to this show, and he heard me say my dad hasn't texted me yet. So if you're listening to that, hello, I still haven't gotten a text from you this week, so that's still an X on this list.
But it's coming, right? Thanksgiving's just around the corner, and we're all going to get that conversation, and we're all going to get. Well, I'll tell you this is interesting. So, my son, 7th grader, came home after his football game yesterday, said, some kids were saying, "There's no way you're my dad," and I'm like, "What are you talking about?" And somehow, right, Twitter or whatever, a couple of 6th graders had seen me and put, because it's a unique name, right, and said, "There's no way this is your dad." No, well, one, he's too old. I'm like, well, yeah, I am. And
kids are so nice.
On the younger kid, but so it is kind of funny when I go to parent teacher stuff and people are like, "Grandpa?" I'm like, "Nope, I'm the dad. I'm the dad." And they're like, "Oh, when'd you get the new wife?" I'm like, "Nope, same wife." And they're like, "How's that possible?" I'm like, yeah, it's a long story. So, but it is interesting in that now they didn't ask for any advice, so that hasn't happened yet. But I just think it is interesting that people of all ages are out there, looking at Bitcoin stuff.
Yeah, I think it is too. I think that's really cool. Well, such tactful kids are. You love kids.
Oh my God, they're so funny. And he's like, you don't look that old, Dad. I'm like, it's okay. It's okay. Fine.
60 years young. All right. So in terms of Bitcoin here, maybe what we're starting to see is the beginnings of that summer fall sort of period that you were referring to there. And I think there are some endogenous drivers there. So obviously the ETF is a really big deal. This sort of shift in regulation and the courts winning some of the SEC charges that they've brought, that's a really big deal. The halving, that's another endogenous catalyst or driver.
Today, like physically today, we're recording a day earlier than we normally do, but today, the part of this pump is the G-Man saying that FTX could reboot under new ownership. That and I guess him saying that, I don't know why it matters, because he doesn't really have regulatory jurisdiction over it. And I guess if they reboot in the US, then he would, obviously. Maybe that's what they're going to do. But one of our portfolio companies is one of the bidders for the FTX assets. So
that's so interesting.
Yeah, we'll see what happens.
Can you say who that is? Or I saw Bullish was involved. There was a headline.
Figure.
Yeah.
Technologies.
Nice. Okay.
One of the bidders. And,
okay. I've got so many questions on that then. Because this is something I was wondering about. And when I first heard that there was a possibility that FTX could restart, I had this knee-jerk reaction of why? Why would you ever do that? And then I thought about it and I let it sit with me. And I was like, what? Actually gut reaction, I could see that. I think a huge part of my question there is, okay, I guess the thing that's valuable there is the consumer and user base, right? Like famously, people are very sticky to these sorts of applications, but I do wonder, obviously, after something like FTX, are they going to be sticky anymore? Then there's the branding question, and then there's the tech question. So like, what does the tech stack of FTX look like? Are you going to keep the name FTX? Do you change it? Like, if you change it, because I get why you would, then aren't you losing a lot of what you're buying? So,
absolutely. Yeah. It's a very complicated question for all those reasons. And at the end of the day, I think the tech stack is fine.
Yeah.
It's fine. I think the UI UX was pretty good. I mean, I wasn't a power user of FTX like some people, but the ones that I talked to that were power users Like the UI UX is better than other places. That's fine. I mean, I think the UI at Coinbase is actually pretty good. I don't have any problems with it. But I think true traders, gamblers and speculators, it's probably more appropriate. They liked it better. So that's fine. The trust thing, right? That's a tough one. Would you really buy your energy from Enron 2.0? I mean, really, would you? I guess if they priced it cheaper, like it's a different team and Skilling's in jail and they're not going to steal from me again. Okay, fine. I think if you really trusted the new management, then yeah, but then the brand is the brand. But I just think it's hard to think, because I'm sitting here trying to think of an example. Was there an example of something that did something awful, some brand that did something awful, and then kept going and was reborn? It's kind of like with me and BlockFi, right? BlockFi didn't steal. BlockFi didn't defraud. BlockFi was a victim, right? Did they have some risk management issues? Yeah, probably. Yeah. Did they need maybe a better manager of the banking? I can't call it a bank, but the banking functionality? Sure. But those people were honest. They're good people. They did not steal.
Yeah, I'm with you on that.
Sam stole.
Total integrity.
FTX stole, right?
Yeah.
Celsius, different story. Voyager, different story. Using a token to leverage, that's different. That's what BlockFi did. So
I'm with you on this. I think this is the tricky part of it, where even Celsius versus FTX, I weirdly feel very different. I was never a user of FTX. But you know what FTX did well, especially amongst crypto natives? They for a while had such a good brand. I was actually just with an up and coming crypto company, and it was kind of like, hey, if you had to pick the brand of something, what would you be? And they had a couple companies, and then they thought and they said, you know what? Before it blew up, FTX, what they really nailed was, at the same time as they were this big, growing, raised a bunch of money, like clearly more corporate-y sort of company, they also, amongst the natives, which is the core user base of these sorts of products, they had a great brand. Because SBF, before we found out who he was, he would respond to people on Twitter. They did memes. They did like cool stuff and didn't take themselves too seriously. And that's the difference between even something like Celsius, which, to be honest, I think everyone in their hearts of hearts was like, oh, I don't know. Okay, they've got a lot of money and clearly they're sophisticated, but like, I don't really know about this brand. But
feels icky.
FTX,
feels icky.
Yeah.
I mean, that's a technical term.
And so that's why I'm just so torn. I'd be very curious to see who ends up winning that deal. I probably now would be on the side that it's a good thing to restart it. You probably have a better road to repairing, to paying creditors back. By the way, Sol going up is also really good for that. So, I think, I'd be supportive of it. But
like it's interesting, and assets are different than people, right? If you take all the bad people away and you have the assets and you put new people in, is the asset's kind of agnostic, right? The asset, the tech, didn't steal your money. The tech didn't fail. The company itself isn't the perpetrator. The people are the perpetrators. People are the bad ones. The people are the ones that stole the client money and gave it to political candidates. They're the ones that did the money laundering. I mean, so I think it's a very interesting dynamic, and it's why, look, we are supporting, our names on one of the documents that's supporting this bid for the assets. And I don't know who's going to win, but I came around like you. I at first I was like, no, life's too short. Let's go build a new one, right?
Right.
Build a de novo. Yeah. But why?
Yeah, kind of with you on that. I think you do have to be really careful about how you manage the brand, assured people. I think on the bullish case, So I'm trying to imagine myself as someone who had and lost a bunch of money on FTX. And then I'm trying to imagine, okay, I just thought this money was gone. Now maybe I'm getting 30 cents back on my dollar. Maybe now I'm getting 50. I think a lot of it would depend, frankly, on if the exchange was getting restarted and I was really confident about this new management and I didn't really have to do much and my money was just going to be there and it reopened. I'm I'm like, I bet there'd be a higher percentage than you'd bet of people being like, you know what? Okay, new management. I'll just I got my money back.
And if they're smart, which I think they are, the way I would do it is I would say, you know what? As a loyal customer, you get a little sliver. You get a little something, something.
You know what? I agree with that.
You know, you get a little bonus. You get a little extra. We're gonna pay you back for your loyalty, and that's so easy, right? You juice the yields. You do, and I don't mean it in an untoward way.
No.
Share. Yeah. You share the profit with the people who, and it would be so easy. And you could do it publicly and you could get a lot of, attaboy, we love you, attagirl, we love you. And I think that's easy. And inertia is amazing, right? Because to move your assets, you got to go and you got to pick them and go, well, where am I going to put them? And do I really? So I don't know. I think it could be interesting.
That's what I mean too, about just the sheer laziness of the average customer, in which I would probably put myself in that bucket.
Inertia, laziness.
Yeah. Okay, yeah. I'm referring to myself, so I'll be a little self-deprecating. It's just,
I know.
It's just you have to move stuff, and I sort of that was my gut tells me too.
Well, I'm the laziest guy on the planet, and it's so funny when I say that, people are like, "What are you talking about? You're not lazy. You work all the time." I'm like, no, I just don't understand. I tend towards laziness. I mean, I love what I do. I love working, but if I had a choice, I'm happy to sit in a hammock and read a book or sit on the beach or go play video games with my kid. I mean, I like lazy. It's good.
All right, everyone, we will be back to the program in just a moment. But before we do, I wanted to give you the inside scoop about something that we've been cooking up at Blockworks these last couple of months. So in March of this coming year, in London, Blockworks is going to be gathering 1,200 of the world's largest asset managers. So that's fund managers and allocators, financial institutions, think big banks, payment providers, etc., and professional traders at the largest institutionally focused conference in digital assets, DAS London. Now, it's very rare that you get the likes of JP Morgan, Goldman Sachs, Point72, the large HFTs, the family offices all in one room at the same time. So if you want to know what the big money is doing in digital assets these days, this is the conference for you. To give you an early sneak peek at some of the stuff that we're going to be talking about, one, the intersection of macro and digital assets, and where are we in the market cycle. We're going to be talking about real world assets, so that's stable coins, on-chain treasuries, all of that fun stuff. And we're going to be talking about things from the allocator perspective. So what are the big money managers in crypto doing these days? And because you are such a good listener of On the Margin, I'm giving you an extra code, MARGIN20. So click the link at the bottom of this episode. Again, use code MARGIN20, and I will see you in sunny London town in March. Yeah. So I wanna get your perspective. We're talking about endogenous factors to digital assets, crypto here. I want to get your thoughts on some of the external factors, which is I still think what's moving markets right now is rates and rate expectations. So here I'm going to show you a chart of a couple of different things here. I mean, it's basically the same thing, but I want to get a sense of the real yields and real yields on the longer end of the curve. And what we're looking at here is basically a representation. This is the 10-year nominal yield. This is 10-year tips. So basically, real yield expectations on a 10-year basis, and then the 10s and 2 spread. So the story here is basically yields have been selling off. They're selling off more on the long end of the curve than they are on the short end of the curve, which means it looked for a little while like the yield curve was going to uninvert or de-invert, whatever the proper word there is. But that we've surrendered some of the progress there. So it was less than 20 bips inverted. Now 2s and 10s is back below 40. And I think the thing to key in here is the 10-year tips yield, which it peaked at 2.5% real yield on a 10-year basis. I mean, that's a pretty phenomenal deal. And I do sort of wonder if the story here is that we had even the whole time the Fed was hiking rates, we had negative real yields, especially on the long end of the curve, which led to loose financial conditions, which is maybe why the market has stayed as strong as it has. We did a huge swing in real yields up into positive territory, and maybe that was as much as the market could bear for a period of time, and we're going to start to see some mean reversion there. And I do my thesis now. I'm editorializing myself here, but my thesis for a while, just because of our debt load, is that eventually we're going to have to move into a negative real yield environment. Wherever inflation and yields end up shaking out, I sort of feel like we have to let inflation run above yields at some point in the next, or like it. Otherwise, I just don't know what we're going to do with our debt. So I wonder if that's part of the picture here for Bitcoin as well. That's a headwind, which was the market sensed a peak in real yields. There's starting to be some mean reversion here, and maybe that's the exogenous factor that's driving digital assets right now. What do you think?
A great analysis that is completely logical and probably right, with one small caveat that I would add, which is if you look at that 60-degree angle on the left side in the two charts on the left, where yields were just skyrocketing, and then you see the peak 3 weeks ago and this collapse. Basically, it's markets are cyclical, right? We're saying history rhymes for a reason. Markets are cyclical, and they go from, it's like a pendulum swinging, greed and fear. Those are the only two human emotions involved in investing. And, we went from this, the Fed started tightening the knob and nothing broke. So they tightened a little more, nothing broke. Then they tightened a little more. Oh shit, stuff's breaking. Like third largest bank failure in history. I mean, no one even talks about that anymore. We had the third largest bank failure in history and just got subsumed into JPM, and okay, we're all good. Like, well, let's think about that for a second. And so, discussions of lost control, but the real thing for me, everyone who could short was short. There was no one left to short. Everyone, every hedge fund, every government, everyone was short rates. And now you just got a big old short squeeze. And people are off sides. Back to your point about, people were writing options and people were, futures trading, and there was leverage. And if you look at the data, it just, everyone was on one side of the boat. And when that happens, you better get to the other side of the boat fast, or else you're going to capsize. And so I think now we're seeing a reaction that will be more persistent than people think. And to your point, the real reason is this: we can't afford, as a country and economy, this level of real rates, because we got a spending problem. And that spending problem, and that deficit problem, and that debt problem can only have one solution: devaluation of currency, right? It's the only solution. There is no other way out. And just look at Japan and look at what happened to the yen, and that's coming. So anyway, that's my thought, is that this is the mother of all short squeezes in bonds right now. And if you were short bonds, you're licking your wounds. We're up, I think, 10% since we started talking about this in TLT.
Yeah. So do you think here, because the question is, right, eventually, I think it's probably a good assumption that we're not going to be in a permanently inverted 2s and 10s yield curve environment. So at some point that would have to uninvert, which means that, yields on the short end has to come down, which the market is starting to price that in for next year, or yields on the long end need to go up, which would mean tightening in financial conditions again, which I have to imagine would be bad for risk assets. one of those two things has to happen. They're not even mutually exclusive. Both can happen at the same time.
The reality is higher interest rates, particularly on the long end, are normally a sign of economic strength, right? Means you think things are getting better. So, and actually I'm doing a webinar later today on this, right? Calling, return to the old normal. Right? We've been in this. The problem is investors. There's a whole generation, right? We had 13 years. So we have a whole generation of investors that only know the new abnormal, right? There was nothing normal about 2009 to 2022. Nothing. There's nothing normal about that. Okay. Zero interest rates. The only other precedent we have is in the 1930s and into the 40s. And people don't study history. I mean, you study history, but no one else studies history. I mean, not no one else, but only smart people study history. And the average person just is ignoring that. And they're like, oh, well, this is normal. Like, no, this is not normal. Normal, right, is actually 5 to 10% interest rates.
Yeah.
That is normal. For the last 100 years, 5 to 10, we're just back to the bottom of the normal. And so the idea that somehow we fixed all of our problems and we're going, well, I shouldn't say. The fact that people keep saying, oh, well, we're going to go back to those new abnormal because the Fed's going to have to cut and they're going to have to like, yeah, they probably are, but that's abnormal. So we're not going back to normal. We're going back to abnormal at some point. I think there's a lot of deflationary stuff on the horizon rather than inflationary. But right now we're more normal than abnormal, and people just don't know how to deal with it. And capitalism doesn't work below the 2% bound. It just doesn't. And at zero interest rates, it really doesn't work. And at negative interest rates, it really doesn't work. You get horrible misallocation of capital. And that's exactly what happened. Now, the one thing that is troubling with all of this, though, is we have this weird dynamic where the average individual was actually pretty smart in this period in terms of their debt management. They extended their duration. They lowered their interest. And so that was actually pretty smart, right? Think about what should the government have done over the last decade? They should have issued 30 years or 50 years or 100-year bonds. What did they do? They issued bills. Idiots, complete idiots. And now they got the bill bond ratio at the highest level ever into a rising rate environment. They're SOL. They're in bad shape. But the average individual is okay. But here's the real problem. Now with this gap up in rates, well, I can't move. Like literally, people are trapped. They can't sell their house and buy a new one because you'd have to buy half as much house. Or prices have to fall 50%. And neither one of those are very pleasant for people.
No. So just in response to the bill versus bonds ratio and the government not terming out their debt. So we had Andy on the show last week. He made the point. He made the point basically that the explicit policy of quantitative easing when they were issuing all of this debt was to take duration out of the market, right? The whole point was to loosen financial conditions for everyone else. So if they had dumped duration on the market in the form of 10s, 20s, 30 years, then yes, the government probably could have financed itself for a long time at a very cheap rate, but it would have defeated the policy purpose of what they were trying to do with all of that.
I mean, they could have dumped it on lots of people, but hell, they could have sold it to Christine Lagarde, although she was busy buying up the European bonds. But I look, Andy, I love Andy. He's great. Did you ask him about Pogo? Did you?
I did. Yeah, I asked him about it.
What did he say?
Yeah, he plays it. He said someone else too. There was someone else, apparently there's an elite circle of financial Wall Street types who play Pokemon Go. So that's the real insider club.
Well, it is an insider club, but it's not quite as insider as the VC crew that plays Magic the Gathering, like high stakes Magic the Gathering. So
I used to play Magic the Gathering. Oh, high stakes. I don't know about that. I played when I was, like 10 or 11 or something.
Well,
like
when
that.
I say high stakes, meaning these are the people that actually own the Black Lotus cards, like the $500,000 card. And probably one of them now is trying to buy the ring card that the kid unwrapped. I mean, this is amazing. This kid, I mean, he's not a kid, he's in his 20s, but he unwrapped the 1 of 1 ring card. And it's arguably worth $2.5 million. And
wow.
He was like literally shaking in the video when he's unwrapping it. And it's just like really cool.
Wow. So, good for him.
Scarcity. No, and look, scarcity, which is part of the reason why Bitcoin is so exciting. It is a scarce asset that is digitally native. So it works in the new, Web3 world, or third generation internet. If you don't like the term Web3, we'll call it third generation internet, whatever. But it's this beautiful technological innovation that replaces trust with truth. And that construct, that simple construct of taking the $7 trillion of trust friction and liberating it is just so powerful. I mean, it's incredibly powerful. And it's not going to happen tomorrow, but it is going to happen. And that's the part it's just amazing. And it's why you can tamp down Bitcoin, as we've seen, right? You can create futures contracts in 2018 and you can tamp it down from 20,000 to 3,000, and then it'll bounce back. And it's like trying to hold a ball underwater. You can do it for a while, but if you slip, it's going back up. And you can tamp down when you do a futures ETF, and the big banks can go short from 69 down to whatever, 15.9. But you can't keep it underwater forever. And that's what's happening right now. And what's going to be crazy in this move, the numbers are going to be so big. They're going to catch people's kind of emotional off-size meter, I think, in a really crazy way. I mean, there'll be some. Go ahead.
That's just a really good point. Yeah, like I can imagine, when Bitcoin starts to flirt with 100,000, I mean, you can see that those headlines write themselves, right? I mean, that's going to be the media.
That's it. And there's just something about six figures, right? We talk about 6-figure salaries, and there's just something about 6 figures that it's an emotional thing. And once this goes from logic to emotion, then the fun starts.
Yeah. And I used to think to myself that as Bitcoin sort of proved itself and got older, and if you just look at the track record of Bitcoin returns, I mean, it's pretty, the numbers sort of speak for themselves. And I used to think that people would come around, and I believe that more and more people will come around, but I think it's just always going to have its haters, in the same way that I've told you this story before.
Always.
I told you the story before when I was one of the first events Jason and I ever hosted. But really, it was like one of these, when Blockworks was still a side hustle for the two of us. I talked to this guy who came to the event, and we were talking about whether or not Bitcoin had a future back in 2018. And we were talking about, well, people thought the same thing about the tech companies and the internet. And he was like, and we were like, Amazon, Amazon did this drawdown for 290% drawdowns. And he was basically, I can't remember exactly what he said. It's like, well, we'll still see about Amazon. It just struck me at that point. I was like Amazon at that point, is a 25-year-old company, one of the largest companies in the world. And this guy's still like waiting for it to collapse. And it was just a really good.
No, Michael, that's such an important point, because I was just going to make the same point. So again, we are becoming one mind, which not on everything, but that's good. But it is, I was literally going to make the same point, that there are still people that are waiting for the collapse of Amazon, of Apple, of whatever. And they will keep waiting. And the crazy thing about that is they're conflating two issues, right? They're conflating volatility, right? Which all volatility is a disagreement about a future state. Right? That's all it is. It's just a difference in opinions and time. And it's kind of like, I think we talked about this last week, that I was having a debate with somebody on something, and we both came to a realization at the same time. We're like, once again, in investing, there's no right and wrong. It's just different timelines. My timeline was short, his was long. And he's like, yeah, you're probably right in the short term, but I'm right in the long term. And we're both right. So it's not right, wrong. It's just timeline's different. And the thing about volatility is if you have no volatility of an asset, what does that mean? It means there's certainty. If I give the government X dollars in a T-bill, they will pay me Y dollars with 99.999999999% certainty, right? I mean, there's a non-zero chance they're going to default, but not very high. And therefore, there's not going to be any volatility. It's just not. And so someone could then lever those up and cause a little bit of volatility if they had to, delever because interest rates moved or something. But if your duration's short enough, you can't even have volatility then. So it's a zero volatility asset. If I buy a longer duration bond, I might get a little volatility because it's not certain what the Fed's going to do. Shockingly, right? Shockingly, unlike the Bitcoin monetary policy, which we know with certainty for 140 years, with certainty, okay? We don't know what the Fed's going to do or not do. So that's just uncertainty. Not good or bad, just uncertainty. If we go to equities, now we're talking really uncertain. Go to venture capital, now we're talking really uncertain. But the idea that somehow the 80% volatility of Amazon stock, 80 for 27 years, 80% vol, okay? A double-digit drawdown every single year, including this year. It's had 2 this year, had an 18 and a 22. This year. And the average is 31, meaning on average, every year you lose a third of your money. So if you ask the average person, how much Amazon do you own? Well, none. The volatility is too high. They don't say the volatility is too high, but why don't they own it? Now, they own it in their 401k and because every mutual fund owns it. But the average person does not own Amazon shares. They just don't. Why not? When was the right time to sell it? Never. You should have bought it on the IPO. Bill Miller bought it on the IPO. His cost is 7 cents. And he's never sold a share. I mean, the guy's a mad genius.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. So here's one last story that I wanted to cover with you here, because I can see this was a cool headline, and I love to listen to the Coinbase earnings calls because that's the one sort of blue chip public equity that we have in crypto space. And Circle is now apparently weighing the prospect of a 2024 IPO. So Circle, the history here is they tried to go public via blank check deal back in 2022. They have very large backers, including Goldman Sachs, General Catalyst, BlackRock, etc. For folks who don't know, they're the issuer of USDC, the stablecoin. Very cool backstory here, by the way. That the founder, Jeremy Allaire, a big internet guy back in the day, started Circle. Circle used to have a very different business model. They sort of they did a bunch of stuff. They owned Poloniex, the exchange at one point. They were really into payments, and they kind of had they had a large, very successful OTC trading desk back in the day. They kind of did a lot of stuff. Goldman backed them back in the 2017 era. There was kind of this huge, they went through a pretty tough time where they questioned everything they did. They sold off Poloniex. It was looking pretty bad for a while. Then they go all in on stable coins. They issue USDC, and it becomes the blue chip stable provider, which is just congratulate. And it's been a huge success story ever since. Now, the reason I'm excited about this is just one, I feel like Circle's a company of other very good actors, and then I could read two earnings calls or two
exactly.
Quarterly reports for our companies, but also because I just think it's a big deal if we start to get more crypto companies going public, which would be cool.
It will be cool, and we're working on it, and Figure is trying to take part of their company public next year, and number of others. So, I mean, that's ultimately the goal. And look, venture capital is a long-term business. It's not a short-term, trading business. It's a long-term business. It takes sometimes decades, to make these great companies and to get accepted. And in some kinds, the technology's scary for people. Still people that hate Coinbase, and they're going to break back to triple digits here probably in the next few days. And again, that's going to just cause cognitive dissonance with people, and they're going to say, I missed it. And they're going to FOMO in, and who knows how fast and far this thing can run. But it's a well-run company that, kind of has a lock on certain elements. And look, when the ETF comes out, and it's going to come out, right? It's not a question of if, it's just when now. So when it comes out, they are going to make a lot of money. Coinbase. I mean, so is BlackRock, but Coinbase is going to make a lot of money as a service provider to that asset. And that's, going to get a multiple, and that's going to be good. So what I think is so interesting right now is how, again, emotion changes, narrative suddenly comes back, to your point of that checklist, which I love. It's the same narratives from 4 years ago, but we had to wait 4 years, right, to remember that that's what we should be focusing on.
Yeah. And it's tough to remember. You've gone through a lot in the last couple of years, right? You've learned, we probably should have refreshed our bear market checklist a little bit better, at Blockworks. There's a lot of stuff that I had sort of vaguely remembered happening from the 2018, 2019 period that, came back and became a force. So,
well, and that's a great point, because we did the same thing, and it's going to end up working out fine. But, we had internally for our fund one, so our earliest fund, 18 fund. Remember, these are 10-year funds. So, you're 4 years in 22, but we had set up this plan and said, okay, when these things happen, when we get through crypto fall and these things happen, we're going to do these things. We're going to sell, we're going to liquidate, and it's not telling stories out of school, but kind of messed up. We suffered from the greed, right? So what happened was, at first it was fair values, 30,000. So once we get above 30,000, we should think about lightening up in our Bitcoin. And when Coinbase goes public, we should sell it. And then Coinbase goes public and it goes up a lot on the first day. Oh my God, it's going to $500. Guys, I don't think it is. But there are a whole bunch of people. And so, we listen to the cacophony. And, so now it's $100. And maybe it goes back to $200 or $300, but it's not going to $500. And Max Kaiser, I love Max, and I love Stacy, and they're amazing. But Max throws out the $200,000 number, right? When we hit 50, he's like, 200, absolutely in play. And I remember the conversation with Pomp and Jason. And again, I'm not throwing anyone under the bus, but I just remember the conversation like it was yesterday. Like, but we said 30 was fair value, and maybe we could get to 2x that, maybe. So somewhere in that 50 number was probably the right play. Like, no, 200, definitely 200. And I am going to call him out on this, that I did win a very large pizza on this bet. So I did bet that, because Pomp had just done his Bitcoin pizza thing. And I said, I will bet you a Bitcoin pizza that we do not hit 200,000 in this cycle. And again, I wasn't being negative. I was just trying to be realist. And, but we didn't sell everything at 69. That's not what we did, to your point, because we didn't follow the process of the checklist. And on this cycle, you can be damn straight, we have a checklist and we have some rules, and there will be much selling going on in crypto fall.
It's just difficult to do.
And again, and I make people say, you're jumping off. But no, for my funds that have a finite life cycle where I have to return the capital to shareholders, I will be selling. For my other funds, which I'm just investing, I will be buying and hodling. So let me be very clear on that.
Okay. Just in closing, there is an analogy here in between VC and operating a crypto company. And the analogy that I would make is like, one of the things that I've heard about is a little bit different about being a crypto VC is if you're not doing just pure equity deals and you're doing deals where there's a liquid token involved, you suddenly as a VC and an investor have to think more about when to sell versus when you're a very traditional VC. It's like I sell when it goes public, and that decision is basically made for you. So it is this new skill set, and you're starting to see this like new class of crypto VC, which is like kind of VC and kind of hedge fund. A lot of these funds are structured in the sense that it's like 50% privates, 50% liquid tokens.
Yep.
In operating a business in crypto, some of the people that I look that have, first of all, not many people have done it for that long. For like, if you look for entrepreneurs that have been at this for 7-8 years, you are breathing rarefied air. And the reason that is, most people get blown out. It's incredibly stressful to bear the volatility of operating a business through these cycles. And I do wonder if like, there's a skill. There are businesses that are inherently cyclical, semiconductors, construction, gold mining, etc. And you know what the skill set that you need to survive is? You need to be paranoid about surviving. You need to have a great grasp on your fixed versus variable costs.
Yes.
You have to just endure time over time. In tech, that's not it. Tech is a game of exponential going up like this. So the game is different there. You load up, right? It's growth at all costs. Don't worry about the fixed costs. Hire as many engineers as you can, yada, yada, and ship it. That is not the dynamic in crypto because there are these drawdowns where if you haven't been careful about your cost base, you get blown right out. And I just think
it's a great, no, it's perfect. And that's because, and it's exactly right. And it's precisely why, and we're 70-30. So we can go up to 30% in liquid protocols instead of 50-50. And that's just a decision we made to have more equity. But that's exactly right. And it's because we live in a hybrid world now. You don't know what the management of whatever project is going to do with their capital structure. It may be token oriented. It may be equity oriented. It may be a combination. And that's not good, bad, or indifferent. It is a new world. And one of the things that's interesting is in Web 1 and Web 2, all of the wealth went to the equity and the apps, not the protocols, right? We're using TCP/IP. Neither one of us owns it, right? Can't own it. Today, 80% of the value so far has gone to the protocols. In the future, I think that number is going to shrink, and the amount that goes to the apps and the dApps and the things that get built on top is going to be higher. But there's always going to be a big percentage in the protocols, because the protocols, in some cases, like Bitcoin is not equity, it's digital gold. So it doesn't have like cash flows like a gold miner, but it has a use case that that will accrete value as a store of value. But Ethereum, on the other hand, does have some ways to participate in cash flow, and there are other things. But then there are others that were just wrong. Like, I love Uniswap, the idea of a decentralized DEX, but Uni, the token, doesn't share the way it should. So I think they need to punt and restart and get a user experience or holder experience where you own some stuff. But, or like, Doge, it's worthless, literally worthless, unless someone finds a use. Like if they started, there was a guy that wanted to buy Parler and was going to use Doge as the token. Okay, that would be a use case, and that would be a way to share in revenues. Or Elon keeps saying, oh, someday I'm going to let you buy a Tesla. Okay, fine. But until that time, it's a zero. Except it has meme value. Okay, whatever. But there will be these things that find a way to mesh the token and the equity economic value going forward. And again, the idea that this is going to go away, that there are not going to be any more tokens, and there are not going to be any more tokenomics, and there are not going to be any more business models, it's just dumb, right? Again, show me a good technology that once it was released into mankind went back in the bottle. I'll wait, right?
That's how I feel too. And I do think that the monkey doesn't go back in the bottle, and things are different now. And this is kind of how it's going to be. And it's not going to be a straightforward line. It'll take time. There'll be setbacks always. And it won't be as predictable. If someone ever sells you a very confident, predictable vision of the future, it is almost definitely not going to be like that, is what I would say.
No. And so it's that for sure, right? It's never a straight line. It's that, wavy line we all see. But the other one is, we've all seen the S curve, right? The concept of the S curve. If you haven't read Harry Dent's book, The Great Boom Ahead, read it this weekend. And it's a short read. All of his other books I didn't really like, but that book is amazing because it describes how an S curve works and why it's important. And everyone needs to understand S curves. But S curves are 30-year cycles, right? First 10%, second 10, 80%. That's the upward slope. And then the last 10 is maturity. We just had the first 10. At the first 4 or first 5, because we just had the 15th anniversary of the white paper, the first 4 or 5, science project, not really there. But the last 10, I will argue, was the first part of the S curve. So we got the 10% adoption. We're at 10 and 11% adoption. Now we're going over the next 10 into this S curve. So what we had, and this is where Tim Draper, who again, mad genius, love the guy, he talks about the IS curve. That in advance of the beginning of the S curve, way over here, there's this little blip. And it's where the innovation first comes out and there's euphoria. And then it crashes, right? And if you look at it, it makes a little I, because there's this dot, there's this punctuated dot where everybody's like, oh my God, this is, and that was kind of 2022. And it crashed. But then that crash, okay, meets the bottom of the S curve. Remember, 2024, which we've been talking about as long as we've been doing the show, and I've been talking about for as long as I've been in the business, is still not here. That's the beginning of this cycle. 58, 54, 68, 82, 96, 2010, 2024. That's the beginning. The next 10 years are going to just be so awesome. I mean,
I can't wait.
So awesome. I think awesome.
I agree. All right, Mark, that's as good of a place as any to end it. Best hour of my week, my friend. I will
always.
see you same time
Have a good one.
Cheers.